Hello, I'm Tom Nichols, head of the Corporate Tax and Transactional team here at Meissner Tierney Fisher Nichols. A question we are often asked is, what type of entity should my business choose for income tax purposes? These so-called choice of entity issues are, of course, important for startup enterprises, but they can be even more important for successful established businesses. There are two general types of business tax classifications. In the first category are businesses taxed at the entity level as corporations under subchapter C of the Internal Revenue Code, called C corporations. The second category consists of so-called pass-through businesses, whose income is passed through and taxed to the individual owners of the business. The first category consists of entities that either are or have elected for tax purposes to be treated as corporations for income tax purposes, and that have not elected to be treated as S corporations. S corporations are pass-through entities taxed under subchapter S of the Internal Revenue Code. The pass-through category consists not only of S corporations, but also limited liability companies, partnerships, sole proprietorships, and other non-corporate enterprises that have not elected to be treated as corporations for income tax purposes. Slide 1 shows top marginal rates for various types of business entities and income. There is a lot of information on that slide. Just by looking at it, you can probably tell that if you're going to do a freeze frame on any part of this video, you will get a lot more useful information from any portion that does not have my face on it. I'll just note this. The initial entity-level top tax rate for C corporations is 35% and can be lower, 15% on the first $50,000 of income. These top rates are 5 to 10% lower than the top rates potentially applicable to pass-through business owners. But that is only half the story. The 15 to 35% C corporation tax is only the first tax that could apply to those earnings. If they are ever distributed out to a shareholder to be used by his or her family, there is another tax imposed upon those dividends. This raises the overall effective tax rate on these distributed earnings to more than 50%, and that is before taking state income taxes into account. This can make a huge difference upon the sale of the business. An example can help to illustrate this. Slide 2 lists some typical assumptions for a profitable manufacturing firm that earns $1 million of income per year. Suppose the owner has the opportunity to sell the business for, let's make it simple, 10 times earnings, $10 million. For tax and other reasons, most buyers will want to buy the assets of the business directly from the entity rather than buy the stock or other ownership interests in the entity itself. Slide 3 shows the substantial tax cost of C corporation status in this typical sales scenario. There are plenty of complexities here too, but just a couple of things. First, there is no capital gains tax break for asset sales inside of C corporations. Thus, the initial 34% tax at the C corporation level is already 10% more than the final tax for S corporation, partnership, and sole proprietorship owners. It gets worse. Sooner or later, the selling owner is going to want to distribute the after-tax proceeds so that his or her family can live off them during retirement. For the pass-through business owner, these distributions are nearly always tax-free. But these distributions trigger an additional almost 25% tax to the C corporation owner. The bottom line is that the C corporation owner is facing an overall effective tax rate on this sale of over 50%, versus a much more favorable rate of slightly more than 20% for the pass-through business owner. That's a difference of almost 30%. $3 million in this $10 million example. And again, that's before taking any state income taxes into account. Even at this stage, there is tax planning that can be done, but it typically cannot completely eliminate this dramatic tax difference. You may wonder whether this substantial tax difference applies for bigger or smaller transactions. Although each deal has its own unique characteristics, in general, the answer is yes. In fact, the differential actually gets slightly bigger for transactions in excess of $10 million. But we've also run numbers for much smaller transactions, such as $500,000. Surprisingly, though the overall rates for both types of businesses are typically lower for these smaller deals, we've found that there can still be a 30% differential. This can be even more discouraging at these levels because there's just less money to go around to begin with. These tax dynamics have helped cause a dramatic shift in tax classification for closely held businesses over the past 30 years. As you can see from slide 4, while S corporations constituted only about 20% of all corporations before enactment of the Tax Reform Act of 1986, they now constitute more than 70%. In summary, whether you are an entrepreneur starting up a new business or the owner of an ongoing closely held business, if you think you might want to sell your business sometime down the road, you really should consider converting to pass-through status if you are not there already. We've already handled a number of such conversions as well as subsequent sales. From experience, I can say that clients are a lot more satisfied long-term overcoming whatever obstacles there might be in getting to pass-through status than having to face retirement with 30% less after-tax proceeds. Obviously, if you think we can be of help in any way in this, please let us know. Thank you.